On the macro scale, it's murky. I don't say that as a cop-out. It's just very murky to me. I mean, there's so many things. You got the Federal Reserve that has come out and admitted to $1 trillion in paper losses right now, unrealized losses. You have a situation where the stock market has turned sour on the big seven, and that's a dangerous environment in and of itself, where the market has been lifted by 7 stocks. And here's the interesting thing. Right now, if you look at the NASDAQ, which has been hit fairly hard, in just doing a little bit of research on it, you find that there are more industrial stocks right now listed on the NASDAQ than technology stocks. And in fact, even more financial stocks than technology stocks on the NASDAQ. And I found it interesting when we talk about breadth and how horrible it's been. Typically when you have just a handful of stocks leading the way, it doesn't portray for good future direction. Typically it's a bad omen. And we're seeing it turn over right now. Will it continue to fall? I don't know. But just so people understand what I mean by breadth, if you had randomly chosen a basket of 30 tech stocks at the beginning of 2022 in the NASDAQ, you'd be down today. And, so almost all of the stocks in the NASDAQ have been in a bear market since late 2022, with the exception of a handful. You look at the Russell 2000, a broader swath of the economy. They represent the broad economy. Almost all of them are down. And so when we talk about the macro picture, look, we have a situation where now you got the Fed talking about lowering rates. What does that mean? We have a yield curve, which has been massively inverted for 2 years. If you said to me, Andy, can you borrow me some gold? Can you borrow me $5,000 worth of gold? And I said, okay, Danny, how long do you need that for? 6 months. All right, I'll charge you 2%. Okay, great. And then you come back to me and say, Andy, can I borrow $5,000 worth of gold and pay you in 10 years? Okay, Danny, I'll charge you 8%. Well, the inversion of the yield curve says you're getting a higher rate on the short loan that I'm lending to you versus the long loan. It just doesn't make sense, right? You're supposed to get more of a return for the longer the duration. Not only is it the greater likelihood you don't get paid back because of the variables, but the opportunity cost of not having use of that money for a longer period of time. And that's what inverted means. For the last 2 years, you're getting paid more money on a 90-day or a 6-month treasury than you would be on a 10-year treasury. That's a very unusual situation. But going back to 1950, Danny, every single inverted yield curve, once it reinverts, once it goes back to normal, where you're getting paid more on the longer maturity than on the shorter, every single time since 1950, I don't know how many it's been, 8 or 10 times, it precedes a recession. And in other words, what you're seeing is the high probability of a big recession coming. And the reason I say big recession is because it might have been, I think, the most inverted yield curve in history, massively inverted for a very long time. And when it reinverts, the probability going back to 1950 would be 100% if you look at what it has been in the past. I guess it doesn't mean it's exactly 100%, but a high probability we're heading into a recession. And so when you see the yield curve reinverting, to me, what that basically says is that you have big money who understand the banks. The banks are not lending money to you and me to start a business, to buy a property, to do a home equity loan. They would rather take that money and not lend it out into the economy because they don't like what they see coming. And instead, they're loading up on short-term treasuries, which is pushing the yield down. So as the yield goes down in the short-term treasuries, because the big money, the banks, would rather put it in there with safety by treasuries than lend it to you and I, is an ominous sign. They are front-running what they see coming. And they're anticipating that the Fed will lower yields on the short-term treasuries, which they're going to do. And when you talk about what this really means, I mean, if it is portraying a recession and the economy starts to slow down and the banks aren't lending and instead are going into treasury short-term, because they know that, things are going to get ugly and they don't want to lend it, and we head into a recession, I think that you'll see rates go even further down on the short end, because it will start to really clog up the economy, really, really slow down the economy in a big way, create a recession, if not worse. You have this urban doom loop that I think people need to understand a little bit more. This urban doom loop, which, you got all of these half-empty buildings, and 70% of the loans are owned by by the regional banks, as are 70% of the small business loans. And these buildings are half empty. And all of the shops and restaurants that have spawned up around these big buildings, these office buildings, well, you throw into it the lawlessness in the inner cities and all of the immigration problems in the inner cities, and the fact that people aren't in these office buildings. So what happens is the people in the office buildings start to go work from home. The businesses around the offices, well, they start to suffer and start to close. So people start to leave. And as people leave, you end up having less in the way of tax revenue. The tax revenue that comes in as a result of all of these commercial properties and all the businesses, which is integral to services within the economy, well, they start to suffer. And as a result, the quality of life starts to suffer. So people leave. And it's a doom loop, and it's getting worse and worse and worse and worse. And I mean, the craziest one I've seen so far is the one in St. Louis, the former One AT&T Center, 44-story tall building, third biggest building in St. Louis, and sold for $205 million in 2006. It just sold for $3.7 million. $3.7 million for the fourth tallest building in St. Louis. And as it gets worse and worse and worse, and more people leave, less tax revenue going to the police and the fire and all of these services, well, then the quality of living gets worse. So more people leave, which just reinforces this urban doom loop. I hate to be pessimistic, and we are talking about that too. There's a fine line between realism and pessimism. But I think if you don't see what's coming, you'll never get out of the way of it. So unfortunately, I'm a hopeful guy, but I don't like what I see right now. And when you see the Fed talking about lowering rates, and you see the curve re-inverting as a result of the banks not lending money and just piling it into short-term treasuries because they do not like what they see coming. So instead of lending it with risk, they'll put it with the Fed and no risk. Yeah, I would say we're in store for some tough times. And then you throw into it the biggest election in the history of this country and all the crap that's gone on around it. Yeah, it's time for people to be defensive, in my opinion. It is not about return on your money, it's return of it. And when we start to see cracks in the NASDAQ like we are in the big seven, which have really been the catalyst for all of the market growth, it's dangerous because people in this country have become addicted to instant gratification, and that's not fast enough. And so you have all these people that have loaded into NVIDIA and into Apple, and what does it mean when they correct? If they do, really correct, it's a big problem. So yeah, unfortunately, my take on the economy is not as rosy as I would like it to be right now. When you take a look at what has happened with the price of gold and silver are managed by the commercial banks. And I mean, that's the truth of it. The commercial banks are the ones that control the price of gold. It's controlled on COMEX. That's ending because the big money across the globe understands this. The central banks have been using the Western suppression against us for a very long time. They know this. In fact, I've said before, the head of the Shanghai Gold Exchange says, when the real price of gold, when China is allowed to speak at the table, the real price of gold will be observed. They talk about the new grain exchange that they just developed, the BRICS grain exchange, and they say, we produce more grain and soft commodities than the West does, yet we have no control over its price. It's all controlled on COMEX. That will change with the new BRICS grain exchange. They understand that we have been controlling the paper price of all of these commodities for a very long time. But I'll give you an example of what just happened. I see if I can pull it up here. I was just reading it. There's a tremendous amount of short covering that has happened on the market. The gold longs sold 4.488 billion in long futures, silver longs 1.7 billion in futures. These are the managed monies. And so leverage is a double-edged sword. So look, here's the deal. There's the commercial banks. What they do is they suck in the speculation. They let the price run, and they will suck in all the managed money, and they'll absorb all of that buying pressure. But they have enough money where they are able to sell into a rising market. Very dangerous thing to do. Most people, when they short, think AMC and GameStop, they short a falling market and pile on, right? It's like, when you played tackle football with your buddies in elementary school, everyone would jump on, pile on, hog pile. Well, that's normal people do when they sell short. The commercial banks have enough money and really unlimited amounts, and they do it in a collusive manner where they are able to absorb all of the buying pressure, let the price rise, and then start to sell and overwhelm the buying pressure and drive the price down. As they drive the price down, all of those longs and all of the options expire worthless, and you get all of the managed money that end up jumping ship. These hedge funds do not have a high pain tolerance. So as the price starts to go against them, they jump ship. When the longs sell their longs and cover their shorts, in other words, they are getting out of their short position, they're selling their longs. The opposite side is the commercial banks. They're taking those longs and they're going long. So in other words, one of these days, and I believe we're getting much, 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 much closer to it, the commercial banks, and maybe this is the time, who knows, will flip-flop and they won't short a rising market. They will push all of the managed money to the other side of the table. And they won't let the price, they will not let the managed money back into it. In other words, managed money will go short. Right now, when the managed money sells their longs and buys shorts, the commercials are taking the other side. And that's what has happened. So the commercials drive the price down. They cover their shorts on the way down. They take the long positions and take the opposite side of the managed money short position. So they're net long. And the question is, will they this time let it run or not? As it goes higher and higher and higher and higher, and the managed money then flip-flops and goes into the other side, will they short the rising market? That is the question. That's the big question. And I think it's very difficult for these banks to consider shorting a rising market in this environment when the rest of the world is standing for delivery. But the reason the price fell has nothing to do with anything other than the fact that the commercial banks clobbered it, literally clobbered it, and got almost $5 billion in gold futures sold and $2 billion in silver futures sold in a week. And that is having, as usual, a profound effect on the price of gold and silver. It is this environment that the Chinese and the Russians and the Indians and the Saudis, they understand what we're doing, and they are using this suppression against us by standing for massive, massive, massive delivery. And we see that continuously. So this game ends, and it ends badly. And I don't know if it ends now or later, but it's to a point where, because the rest of the world is looking at commodities as being far more valuable than the paper currencies that purchase them, and they're using the exchanges and their delivery mechanism to reposition, it becomes very dangerous to hold short positions. So this is a short-term deal as far as I'm concerned. Yeah, technicals are not wonderful right now, and that's part of the deal. The commercial banks are able to paint the tape, make the technicals look bad, get the managed money to capitulate and sell, and allow the commercial banks to take the other side of that. So yeah, it's a little bit of an interesting dynamic, but one of these days, and I think we're getting closer than we've ever been, the commercial banks will make more money on the upside than they did on the down, and they'll let it run, and they will fleece the managed money like they did here. The question becomes now, as the price rises and the managed money then starts to go long, will the commercial banks really step on the shorts? And like they've always done, rinse, wash, and repeat. But they've been able to do that because the world never stood for delivery. No one ever stood for delivery on COMEX or the LBMA. And, on the LBMA in London, where they're trading right now almost 3 billion ounces of silver per day. That's 3.5 times annual global mine supply. They're trading 10 times the amount of gold or silver they have in the vaults every single day. And that is all rehypothecation. And the same thing is true on COMEX. Silver is rehypothecated 1,600%, meaning if 16 of us have a contract saying that we have 5,000 ounces of silver and we all stand for delivery, one may get delivery, 15 will get cash settled, and that's force majeure. That's a default, the exchange blows up. But the fact that these countries, these sovereign nations and sovereign wealth funds are standing for delivery is the key to it all ending. And we're getting closer, not only in environment, but also in the understanding by the big money across the globe that this is how they win the game. They don't need to send missiles to the United States to win. They just need to sell treasuries and buy commodities.